All right, welcome everyone. We're going to kind of have a pretty normal review of returns. Another very solid quarter of returns on both an absolute and a relative return basis, building on a number of years of very solid returns. Adam will cover that during his session. He's also going to cover the just passed and enacted big, beautiful bill and so the implications for us, especially the investment implications of that. Andy's going to go into sort of the under the hood review of our equity strategies. We've just implemented a new part of our process that he'll cover in this. That's just very interesting as we follow the dynamics of the market. One of the keys to our success is really being adaptive as the market evolves through time. And there's clear evidence that we've gone through sort of a pretty significant change in terms of the way the normal market behaviors occur, and he'll cover how we're adapting that. And then, as Andy mentioned, we've got the opportunity for more questions, but we've already got a pretty good queue of questions that have been submitted ahead of time. So I think we'll have a very active Q&A session at the end. So Adam, kick us off, please.
Great. And before we dive into the numbers, I want to make a quick shameless plug. I know it's gone out via email. And Andy, you can help me here with some of the logistical pieces. But after many years of discussion, we've finally taken the leap and launched our own podcast. It's called Long Story Short. We're doing weekly episodes. It is on Spotify, the Apple Podcast dashboard, YouTube. What else, Andy? Am I missing anything else of those?
Yeah,
the three
you'll be able to find it. Yeah, you'll be able to find it anywhere you get your podcasts. I personally listen on Overcast. It comes through to my feed right on time. So anywhere you listen to podcasts, you'll be able to find the show. You'll probably need to search Long Story Short Bernie. Make sure to add that little Bernie piece in there. Or you can just follow the links from our emails.
Okay, great. Yeah, we're real excited about that. They episodes are released every Friday. They're about 30 to 45 minutes in length, and covering everything markets to financial planning. So a good complement to these quarterly webinars. So going to the quarter, what happened last quarter? That's definitely a literal question we need to ask ourselves, given that if I would have put on paper, we had a 19% top to bottom decline in the stock market, serious discussions about a trade war, bombing, Iran, Middle East tension, and a lot of other things in between, we probably would have said that most of the things on our 2025 concerns bingo card were hit in just a 3-month window. And despite that, we saw incredible resilience in the market, almost a pure, good old-fashioned V-shaped recovery with global stock markets bouncing double digits. So you've had the U.S. market up about 11%, international and emerging market equities up about 12%. So incredible resilience, really driven by a couple factors, which we'll highlight, mainly earnings, the health of the labor market, and the health of the consumer. Even diversifying assets with a lot of yield movement around trade discussions, yield movement and currency movement really combined, and seeing fixed income still post what's looks like a pretty average run-of-the-mill quarter. So Q1 was a little more volatile, less exciting for a Q1, coming off of back-to-back strong years in 23 and 24. But really amazing resiliency, and a great reminder that despite a lot of headwinds and headlines, stocks are going to focus on fundamentals over anything else. So next slide here, Andy. Something that I thought was really interesting. A lot of the conversation the past couple of years has been around market returns really being only driven by a handful of stocks, right? The Mag 7, representing some of the largest technology companies in the world here in the U.S., and incredible performance from a return standpoint. So certainly they did help drive a lot of the market coming out of the bottom in 2022. But what we're seeing right now is really encouraging, and this is from left to right, the top performing sectors in 2025. So you see sectors like industrials and utilities leading um, in the rebound, and you still see sectors like technology, materials, financials doing incredibly well. What you see visually is broader participation. It's not just one or two sectors driving the bus. You see, pretty uniform, strong performance, even in light of, these little grayed out dots are the drawdown we've seen so far this year in each of these sectors. So, I mean, tech, you had, pretty much a bear market, and then a subsequent recovery. So some of these sectors, as we know, the S&P sold off about 19-ish, 20%, depending on who you ask. Some of these sectors took a real beating and bounced back nicely. And something that kind of supports this in the theme of tuning out the noise. We always love coming into the new year because it allows all the uh, stock prognosticators on Wall Street who have to set up these annual price targets every year, and their sole job is to make the weathermen look good, because they're typically very wrong, and they move in response to what the market's doing. So here you've got 14 or so of the biggest Wall Street institutions, ranging from Goldman Sachs all the way through RBC and HSBC, like multinational institutions that spend a lot of time and energy trying to guess and establish price targets for the S&P 500 in any given year. And so this V here literally follows the stock market movement this year. They all came in with really lofty expectations for what the market was going to do. They all really aggressively cut their price targets after the market sold off. And as you would guess, they've subsequently done a really good job of revising them back up as the markets recovered. So just probably some food for thought as we get into the second half of the year and people start trying to make guesstimates around specific price targets for indices. And the next time we do see a sharp correction like we saw in April, and you see those headlines, so-and-so cutting their S&P price target, it's not out of any sort of a crystal ball. It's literally what they know how to do best. And so kind of dialing back on that theme, looking back several years in terms of general market trends, 1, 5, 10, 15, and 20 years, I'd say in the rearview mirror of the last 12 months, something that's been really encouraging is global participation in the stock market rally. This is no longer a handful of companies or a specific sector. The stock market rally has absolutely broadened globally, which is really encouraging to see, with actually international developed equities leading. So clients in diversified portfolios, they've finally been able to reap the rewards of global diversification after many years of a US only stock rally. We've gotten a lot of good questions about the bond market still. 2022 definitely turned bond investors upside down with, we talk a lot about the stock market recovery, but the bond market is still coming out of a historic decline, from a few years ago. But bonds with higher yields now, kind of in front of us, and on a forward-looking basis, bond returns have stabilized with a higher starting point for yields. Looking back 5, 10, 15 years, you start to see that gap between domestic and overseas equities narrow out a little bit. There's a lot of talk about, hey, given what the U.S. market especially has done, should we be concerned? Are things too frothy? Are we at the top? We're getting more pings now on our cell phones about new all-time highs. So we really want to take a minute and talk about where we are now and then looking forward, because it's amazing having had an almost 20% decline in the market just a couple months ago and such a quick reversal in stocks. We're already hearing questions around, hey, all-time high. Should I be taking chips off the table? Should I be worried about the next big risk in front of us? And despite how intuitive or counterintuitive it might seem, all-time highs are actually a really positive indicator for future stock returns. Here we see forward-looking 1, 3, and 5 year returns from an all-time high the dark blue bar being the return if you've invested in an all-time high, and the grayish bar being any other time, not an all-time high. And you notice that investing at all-time highs is actually investing from a position of strength. Forward-looking returns from those levels tend to be higher. Really positive years in the market and above average returns tend to cluster around one another. The issue is just determining when that's going to happen and how long it's going to last. But I think in general, despite the conversation around a handful of companies or speculative trading, we're seeing a really broad-based, rally in the stock market from a really favorable point on a still favorable economic backdrop. So to ease or to kind of try and answer those questions of why is this happening right now, a few things I wanted to point out in general, market-wide. The first is you've been seeing probably this year some headlines or talk around so-and-so levels of consumer debt are at new all-time levels. Credit card debt is rising, and things that, especially after 08, anything related to debt and lending tends to get people nervous. But you've seen that more filter into the headlines as the markets continue to go up. But I think this chart from JP Morgan does a really good job from their research desk showing it's essentially depicting household leverage. So the ratio of liabilities to net worth. And what this is, you see the big spike in the middle from 08, the financial crisis, but you still see record low levels of household leverage. So while on a dollar term, certain liabilities might be going up, that conversation completely neglects the asset side of the balance sheet. So liabilities might be rising slightly, but assets are rising at a much greater pace, which is why we see this trending down at such a low. So a very under-levered consumer. U.S. households are in better shape than they've historically ever been. The next slide here, which is the ever resilient job market in the U.S. Unemployment still hovering at and around 4%. It's been incredibly steadfast in, it feels like every month or every quarter there's this waiting game of when is the labor market going to turn, and that really started back in 2022 when rate hikes were happening really aggressively. It was like, okay, next month or next quarter, we're going to see a real big spike in unemployment. Jobless claims are going to go through the roof. And that's not happened at all. And you've seen a really, really steady labor market. Is wage growth slowing? Yes. We're coming off of really aggressive levels. But in general, unemployment has really hung in there in a higher rate environment where the economy is still growing, but it's slowing down a little bit, and that's perfectly fine. So that's a general market backdrop in the economy in general. We feel certainly surprises happen. We saw one happen in April of this year. We saw one happen in 2020 with COVID. That's why balanced diversification and a conversation with your advisor about risk level is so important. But there's a lot of really positive things to point to right now in what historically would look like the early to mid phases of a bull market cycle. So now shifting over to something that's a lot more exciting to talk about than the stock market, and that is taxes. And usually these things come out and they're crammed in at the 11th hour, and there's not a lot of room for planning or kind of a review of how the tax bill may or may not affect you. This year we got something done relatively early at the midway point, so we'll do a quick. This thing is 900 some pages long, and there's a lot of different layers to the new tax bill. Our job is just going to be to focus on what's in here that we think is relevant to most of our clients, and what are some planning items we might want to talk to our advisor about. So just looking at the last 15 years, we've had four main pieces of tax legislation come through. The big beautiful bill clocked in at 900 pages. Inflation Reduction Act in 2022 was mostly corporate tax legislation and a lot of clean energy stuff that came out, with about 750 pages. The Tax Cuts and Jobs Act was kind of looked like a pamphlet compared to the big, beautiful bill, 430 pages, had a lot in there. I was surprised by that number, not having memorized the number of pages, but there was a lot of meat on the bone in a short, condensed form. And the Affordable Care Act was huge for tax planning, and really focused on the healthcare tax credit subsidies, the new net investment income tax, and additional Medicare tax. There was tons of tax planning with the Affordable Care Act. That also got passed early in the year. That was in March, but had some good planning wrinkles inside of it as well. So this is a big bill coming out in the middle of the year with a lot of little nuances we're going to talk about. So what are like the four main bullet points that are most important when we peel back all the different layers of the new bill? The first is from an income tax rate standpoint, it created a permanent extension of the 2017 Tax Cuts and Jobs Act income tax rates. And when we say permanent, we do it in air quotes because permanent just means it's not set on paper to expire at any point. It's essentially permanent until another party gets elected and they decide to change it all over again. But at least for the foreseeable future, we've got this permanent extension of income tax rates. So no big surprises coming through in 2025 or 26 as originally expected when these would have expired. The increase in the SALT limit was something that the blue states really lobbied hard on since 2017. One of the big points of contention in the Tax Cuts and Jobs Act was if you itemize and you pay state and local taxes, you're capped at deducting only up to $10,000 of SALT taxes. That's whether you file single or joint. It didn't matter. 10 grand was your ceiling. That now has been bumped up for a 4-year window. 5. It's through 2029 fully. It got bumped up to 40,000. And that's also whether you're a single filer or a married filer. So you've got from 2025 through 2029 with a higher SALT limit. If your income exceeds $500,000, you start to get phased out of that. And then at 600,000 in income, you go back down to the $10,000, cutoff that was there originally. So the really big thing here is if you're below $500,000 in income, no worries, you get the full SALT write-off if you itemize. If you're between 500 and 600 grand in income, that's a huge point of planning opportunity because for every dollar you reduce yourself in that threshold, you pick up an incremental write-off on the SALT side. That's really valuable. Third thing here is with charitable giving. One makes a lot of sense. One is incredibly random. The first is if you take the standard deduction, you have not been able to write off charitable gifts. Outside of COVID, there was a really short window where a married couple could write off up to $600 of charitable gifts if they took the standard deduction. We've essentially brought that back and now increased those limits. So a single filer that takes the standard deduction can write off $1,000 worth of charitable gifts in a year. And if you're married, you can bump that up to $2,000 a year. So that's kind of a little gift for those that take the standard deductions and are charitably inclined. That starts next year in 2026. So the permanent extension of the rates, the SALT limit, that all takes effect this year. The changes to the charitable giving take effect next year. One more thing on the charitable front that's very, very random is if you itemize and you make charitable gifts, just like with medical expenses, you can't deduct medical expenses until they're in excess of 7.5% of your AGI. The same thing will now apply to charity, but instead of a 7.5% floor, it's a 0.5%. So no idea. I guess this is there to pay for certain other pieces of the bill, but and it discourages charitable giving to some extent, depending on the individual and their gift amounts. But if you itemize, the first 0.5% of your income worth of charitable gifts will not count. You can only deduct gifts in excess of that. And then finally, this was a huge talking point around election time for us and our clients. At the end of this year, the estate tax exemption was going to sunset. It was going to sunset back from about 14 million per person down to 7. So it was going to really broaden out the number of people subject to that punitive 40% estate tax. That was the higher estate exemption limits are kind of here to stay. It's gone from 14 million per person to 15. So a married couple can give away $30 million during their life and at death and not worry about the 40% estate tax. That's also permanent, and that's effective next year. So just some clarity and some peace of mind around the giving and the estate exemption. One more thing that's not on this list that I want to mention, we got it in our Q&A, so I'm sure we'll talk about it again when we get the questions. It's the new deduction for seniors. So starting this year, taxpayers that are over the age of 65 or 65 and older can deduct an additional $6,000 per individual on their tax return, whether they itemize or take the standard deduction, it doesn't matter. It's a below the line deduction. So a married couple, both spouses 65 can write off an additional $12,000 against their income for this year. That was meant to replace the no tax on Social Security, campaign promise. It doesn't quite operate that way, but it's a write-off for seniors nonetheless. That is valid through 2028, and this is something that's is a point of planning as well, because there's income limits. $150,000 for a married couple, $75,000 for a single filer. Once you get above those income limits, there's a phase out, and you start to lose some of that deduction. But that's something that it's going to be relevant to some number of our clients to know and think and plan about with your advisor. So finally, summing things up on the tax front, 3 big takeaways on this tax bill. The one positive is the certainty. Again, we were worried about certain things sunsetting, going away, getting greatly reduced after this year. While the bill is very expensive, it does give us some planning certainty with clients. It expands the opportunities for wealth transfer with this new 15 million per person estate exemption. If you made any drastic changes to your estate plan with the thinking that the estate exemption was going to go back down to 7 million or so per person, it might make sense to revisit that. It also might be completely fine to keep in place what you have, but it's just an opportunity for conversation to see if any estate changes might be warranted. And then I think the gates for proactive planning have opened up a little bit. So now that we know the tax rates are going to be staying roughly the same, things like Roth conversions, things like distribution planning, and then, retirement distribution planning in the context of things like this new deduction for seniors and the new SALT limits. So there's some moving pieces that I think can create some opportunity. Us and our tax team have the opportunity to now kind of take a snapshot of where we are, look at how the new tax bill might impact you, and run some numbers and get ahead of it. So it being passed in July, the one positive is we've got 6 months, at least for this year, to start to think about this. So any questions about the tax bill, we put out a podcast and also a blog post on some of the details, and then your advisor is armed with a lot of great resources to continue the conversation.
Awesome. Thanks, Adam. Yeah, we actually recorded that podcast 3 different times just to make sure we had it perfect and down. So certainly a lot of good stuff in the pod. But I wanted to switch over now to talking about our U.S. equity strategies real quick before we hop into the Q&A. And before we get into things, though, I just want to ask everyone to do this exercise with me. So the stock market started selling off in February, but it was kind of run of the mill. And then early April, we get Liberation Day tariffs. We get quite a bit of volatility. I want you to think back to how you were feeling at that time. Like, maybe you just ignored it and didn't even notice the storyline. But my guess is most of us had some sort of a stress response as a result of the market selling off like this. Whether it was anxiety, whether it was mild or severe, maybe you were losing sleep, maybe you weren't. I just want you to think back and try to honestly ask yourself, how was I feeling in early April when the stock market was selling off? And then I want you to compare that to how you're probably feeling now. Like, sure, you might have some concerns and overall worries. I think we're seeing that with some of the questions that we got from the Q&A. But by and large, the stock market's making all-time highs again. Portfolio values are on what feels like firmer footing. And my guess is that everyone's feeling a lot more relaxed, a lot more rational today than they were back then. And I want to compare and contrast those two timeframes because psychologists, talk about there's hot states and there's cold states for our brains. And basically, when we're in a hot state, our brains are kind of on fire, right? Our amygdala is firing, our fear response is firing, our stress response is firing, and we're actually not able to think as rationally then as we are in a cold state when we're able to think rationally. Our prefrontal cortex is working the way that it's supposed to work, right? It's not being overwhelmed by other parts of our brain. And the reason I point this out is I can't tell you when, but I can promise you that we will go through another negative time in the market where it really sells off hard like it did back in April. And I think what's really helpful is coming up with a plan now when you're in a cold state to think about how you're going to deal with it, right? So like, that the stock market decline will happen at some point in time, may not happen for 5 or 10 years, but getting yourself prepared for that eventuality, I think is what can set people up for success. And what I've noticed, I think most everyone is doing a really good job these days of riding out these short, these periods of volatility. And it's been great because the stock market sells off and it comes back so fast. It happened in 2020. It happened in 2025, less so in 2022, but it did come back in relatively short order, not quite as fast. But I just think that behavior of staying the course is really the most important thing when it comes to having success in investing. Make sure you have an asset allocation that works for you, but if you can stay the course and stay in the game, even when things get tough, that's what sets you up for success. So I just wanted to address that now because sometimes, we go through a period of market volatility and we talk about it a lot in that period, but we never revisit it and do the postmortem. That's what I make sure that everyone is kind of thinking about that now, that we're on firmer ground. But rolling into, kind of more of the specifics of our investment strategies, it was a really interesting last month, I would say, for the stock market, because if you think about it, large growth stocks, which that's the LG on this table, are just so different from small value stocks, right? That's the SV sort of at the bottom middle of the table there. Like large growth stocks, think Apple, Meta, Microsoft, Nvidia, right? Just these massive, now these days, trillion-dollar companies. And then small value companies might have $1 or $2 billion of market cap. They're probably not, doing anything that's, overly, sexy by market standards. Maybe they're relatively boring companies, but they're very profitable. And so what we normally see is like, if large growth is doing well, small value isn't doing as well, or if small value is doing well, large growth isn't doing as well. So it's kind of a really interesting month that we just went through, where we saw large growth doing really well. And the second best performing segment of the market was small value stocks, right? Normally we'd expect them to be on opposite ends of the spectrum, but those were the two areas that did well in the last month. And I think that's really interesting because it's been the case in recent times and certainly year to date where we've seen small and mid cap stocks just struggle relative to large cap stocks. So whether it's the year to date column or it's the 1 year column, you can see that large caps, especially large growth, have done just a lot better than the smaller segments of the market. And I talk about that because I think there's some really interesting things happening under the hood of the market right now that we're beginning to position portfolios to take advantage of. So for one, this is the chart that we like to share. I call it the wave chart. We've kind of zoomed in to just the more recent time frame, last 10 years or so. But basically, as the chart goes up and it turns green, you kind of have to squint to see the green because it's been such a large cap dominated decade. But that implies times when small cap stocks did well. So small cap stocks actually did pretty well coming out of COVID, and there was a little bit of momentum early in 2023 as well for small cap stocks. But for the most part, you're seeing red on this chart, which implies that large caps are outperforming. And so if we zoom forward to where we are today, certainly the case, we seem to be in a well-defined large cap phase. It's been happening for a long time. And it just seems like, we're firmly entrenched. So our portfolios are certainly leaning into large caps. The majority of the money in our portfolios are in large cap stocks. I've got some caveats to that point, but I'll just leave it there for now. But I think the really interesting thing is we've also sort of seen the last 10 years as being, generally speaking, a pro-growth timeframe. And that's certainly the case when you look at, this looks back 20 years, this chart here. But if you look back at, cut it in half, just look at the last 10, you probably see a little bit more red than green, though we did get a pro-value phase in 2022, during that time frame of high inflation. But when we look at this chart, what I'm seeing, fast forwarding to today, is it seems like we just went through kind of a typical pro-growth market phase, both in terms of magnitude and length of time. And it seems like the market is rotating towards value, right? We're beginning to see a pretty clear trend line on this chart. This looks back at just the rolling, past year. How has growth versus value done? It just looks like we're heading into a pro-value phase. But if you look under the hood here, you actually see, large cap stocks and mid and small cap stocks behaving differently. Now, typically, I think that what you'll see is growth stocks, whether they're large, mid, or small, behave like growth stocks. They're all kind of correlated. They do the same things, vice versa with value stocks. And so our assumption historically has been we're going to set the large cap target separately from the value and growth target, right? And so if we're leaning growth, then we're going to lean growth amongst large, mid, and small. If it's value, we're going to do the same thing. All, whether it's large, mid, or small, we're going to lean value. But interestingly, when we look at the large cap, market, this is basically, you can think of it like a tug of war, so to speak, where, when the line is getting pulled to the top, that means that value is outperforming. And when the line gets pulled to the bottom, that means growth is outperforming. So this is not a rolling chart. It's just kind of showing you what the trend has been recently. And we can see since, starting in 2023, large growth has been outperforming large value pretty consistently over this whole time frame. So we can see that the tug of war is being pulled down to the bottom of the chart. That means large growth is outperforming large value. And if you look at this chart and the trend lines on it, it looks like there's, full on momentum towards large growth. Interestingly, though, when we look at mid cap, so now we're talking about stocks probably between $2 and $10 billion in market cap, it looks exactly the opposite. So we see here that there was actually quite a bit of mid-value outperformance over mid-growth coming out of COVID. Then there was a relatively short period of pro-growth momentum amongst the mid-caps from 2023 to kind of the midpoint of 2024. But then ever since then, we've seen a pretty sustained mid-value outperformance over mid-growth stocks. So here, while we're seeing large growth outperform large value, we're seeing mid-value outperform mid-growth during that exact same time frame. So I think that's really interesting. We see sort of a similar trend in terms of small caps, where again, a big value rally coming out of 2020 that lasted until 2023. Bit of a growth move down, and then ever since then, it's sort of been trending sideways. So there was a short small value rally over small growth before things flipped back down again, probably associated with Liberation Day. But if you look at the chart, you can see that the line's kind of moving back towards small value again. So it's maybe a little bit unclear what's going on in terms of small caps, but certainly in mid caps, there seems to be a pretty sustained value trend, whereas in large caps, it's growth. And so what we've done is we've taken a look at that. And for the first time, I think ever, we've decided to break out the style decision, so that's value growth, by market cap. So in large caps, we're actually leaning growth because, as you saw, that's where the momentum seemed to be in the market. But in mid and small caps, we're pretty heavily leaning into value. So these pie charts here kind of show you what the weights look like across large caps and small and mid caps. And when we look at over like the entire portfolio allocation here, what we see is the majority of the portfolios here in blue are large caps, right? That's 80% of the value is large caps, but that LG large growth box is bigger than the large value box. And then when we look at the gold, that's mid caps. The mid value box is bigger than mid growth, and when we look at the gray box, again, small value bigger than small growth. So we're breaking apart those two things. So it's almost like we're both playing growth and value at the same time. It's just dependent on the size of the company. And again, that's our reaction to the data that we're seeing in real time. I think this is a really interesting theme and something that we're going to continue to monitor. But and I think if we talk about like some of the reasons why we're seeing this trend, the AI trade is probably part of it. And the biggest, winners of the AI trade tend to be the biggest companies. It's your Microsofts, your Metas. Apple isn't quite in that game yet. Maybe that's part of the reason why they've lagged this year. But, NVIDIA obviously is probably the biggest winner from the AI trade itself. I think that those gains are just accruing to those mega cap stocks, and it's keeping that pro growth momentum in the large cap space. That's really not trickling down. And so we're seeing value work, and we probably covered this in the past, but we actually expect value to outperform growth over the long term. That's what the academic research says. And we're seeing that in mid and small cap stocks. We're also seeing that internationally, where internationally we're seeing value outperform growth as well. So I think it's really uniquely a US large cap, really a US mega cap phenomenon that's creating this diversion, and we're adjusting portfolios accordingly. So with that, I did want to get into the Q&A session. So I appreciate everyone sticking with us so far on this webinar. The questions came through, and I think there were a couple broad themes where, I think there were questions about the economy, about the stock market. There were a few questions about bonds, and then there were questions about the new tax bill. And so we'll get into all those points. Again, if you want to ask a question, we're still accepting new questions. Just scan that QR code. You'll be able to ask a question directly to us, and we'll answer it here. But what I wanted to start with is I wanted to start with some of these questions about the economy. And so let me highlight this one, because we had a couple questions talking about like de-dollarization or concerns about the US dollar and its reserve currency status. And so this question in particular references the US's heavy debt load, and is asking about what kind of impacts can we expect from domestic investments, so both stocks and bonds, in a scenario where the dollar is no longer the reserve currency, and are there any early indicators that this kind of rotation would happen? So Lowell, I know this is something that you often talk about with the deficit we have here in the U.S., but I'll throw this one to you to start.
Yeah, thank you for the easy one first. So, I share this concern. We have really a major problem that both parties share in terms of the lack of any sort of desire for fiscal discipline. The fact that we are the reserve currency and we can continue to print money allows us to get away with this. But we're to me, I feel like we're acting like drunken sailors on leave. This has got to have a bad end eventually, and the day that we're no longer the reserve currency is probably close to the day where where the ramifications of this will play out. Fortunately, for the short and intermediate term, there's no real good option that the world has. So I think we're going to be fine. In fact, I'm pretty confident that we're going to be fine until this problem runs itself out a little bit further. If you go back through history, there's always been a reserve currency, and it's not always been the U.S. that's done this. We had the Dutch and the Brits, at various times, kind of in the same economic position that the U.S. is today. And so you can look what happened to them, and it's not like they become destroyed economically when this transition occurs to a different reserve currency. But it is concerning, with the debt levels that we're just piling on top of already high debt levels. That probably it's our kids and grandkids that are going to have to pay the price for this. But it's a concerning thing. But I don't think there's going to be a price to pay in the short and intermediate term related to this.
Yeah, in that regard, it kind of reminds me of like other long-term issues, things like, I don't know, like climate change or like diet and exercise, right? Where like there's a lot of stuff that you can do today to set you up long term, but those benefits don't accrue until so far into the future that it's really hard to incentivize like good behaviors. Like good behavior in this case would be fiscally responsible, budgets coming from Congress, right? So that'll be just an interesting thing to watch. I think the last prominent politician who really campaigned on something like that was Paul Ryan, and we all saw how that went. So it's just a really hard problem to solve. That said, I think there are some things that investors can think about doing to sort of set themselves up. And you mentioned in your answer like there's going to be the day where we wake up and it's and we're no longer the reserve currency. It's unlikely to be like something where there's like a big switch and all of a sudden the world goes from using the U.S. dollar as the reserve currency to something else. If anything, it'll be kind of a slow bleed, just sort of small incremental changes that happen through time that eventually add up and could result in like higher um, borrowing rates for the U.S., which could trickle through to other stocks. So I think one of the things you can do to really hedge against that risk, however, is to think about having a global allocation to your investment strategy. So again, we don't know when or if there's going to be any negative impacts to the U.S. stock market. Obviously, there's a lot of things that go into the stock market in terms of its pricing, and this will just be one of them. But one of the things that you can do to hedge that is to make sure that you are globally diversified, and that's sort of in and of itself a hedge against any budget related issues for the U.S. stock market. What one other question on this is how what do you think is the likelihood of de-dollarization, right? So maybe you can answer that in the short term, midterm, long term, but Lowell or Adam, if you have any thoughts on just kind of the timing or the likelihood that this actually happens. Because I think the thing that this is a big talking point, but I think most financial professionals don't really see this as being a real issue, at least over like 5 or 10 years.
Yeah, it's fair to.
Adam, I think you've got some, sorry, I think you've got some statistics, Adam, that will help with this. I'll let you handle this one.
Yeah, so right now, I mean, it's not really a close race, despite some of the headlines of what you might think and hear. The dollar still makes up roughly 60% of global currency reserves. It's followed by the euro, which is at about 20%, and then the yen is third in line at about 9%. So there's not really, there's some horses in the race, but it's not really close. The dollar is still dominant and has been, and we've been right. I mean, well, you probably have context on the specifics, but like, how many decades have we been talking about this? This has been something, especially go back 15, 20 years, and I would have brought up our debt levels and the dollar, and you could probably get concerned about a lot of things. But how do we feel today about our economy versus then? Like, we would all say that the economy is in a significantly better position. We've seen productivity advancements, and we're about to go through this massive new wave with AI where if all things go as planned, we're going to get that much more productive as a society. So that's another force that's going to fight against this. But for now, there's not. There's a lot of like global conferences happening about trying to go against the dollar, but 66 countries still peg their currency to the dollar. So you've got almost 70 countries and 60% of the global currency reserve. It's that way for a reason.
Yeah, for sure. So, again, probably something that might be an issue at some point in the future, but it's difficult to predict what will be an issue right now. So I'll go ahead and move on to like a related question to that point. 1 second to pull it up. So, one of the things that I mentioned as a possible hedge is making sure that you're globally diversified and investing in international equities alongside U.S. equities. And so we've seen international stocks finally show up. And really, when the U.S. stock market was selling off in April, international stocks were sort of saving the day. So if you had an allocation to especially developed markets, but also emerging markets, your performance was probably better during that whole period of volatility than it would be if it was just in U.S. equities. So the question here is, will international equities continue outperforming U.S. equities, with the weakening dollar maybe as being one of the sources for growth? Adam, since you work so heavily on our asset allocation models, I'd be curious to get your take on this.
Well, if you invest in an equity outside of the U.S. and you don't hedge it against the dollar, you pick up two sources of return. You pick up the return of the underlying company and their performance, and you pick up the return of the currency that stock is denominated in. So in a world where the dollar is continuing to weaken, then that would mean relative strength for other currencies. So things like if the euro strengthens relative to the dollar and European equities continue to do well, then that would be a really great tailwind for European developed equities and any other country with the same dynamic. If you look at this year, we showed that chart showing the wide, the relative performance gap between domestic and international stocks year to date. Um, Actually, about half of that international equity return is currency return. So if you take currency movements out of the equation, it kind of shows like a more uniform percent per percent almost rise in equity performance. But the weakening dollar has been a huge boost for those stocks, and it's almost doubled their returns. So if that trend continues, then absolutely. But I would see that more of a source of diversification, right? The dollar is going to fluctuate based on interest rate dynamics, trade policy discussions. A lot of things are going to move the dollar, and it's totally normal for it to be cyclical. Actually, the period we're coming out of like incredible dollar strength for a long window of time is pretty abnormal. Normally, it's more of this game of ping pong back and forth, and that's why you pick up such great diversification benefits investing overseas. So, um, I would say from a valuation standpoint, with overseas stocks being relatively less expensive compared to the US, with the prospect of us coming out of this like dollar only currency regime, that plays in favor. But I think what you're still battling is like, where are the best companies in the world right now? Who's competing against our best companies, and where are they located? And so that's where, from an asset allocation standpoint, we want to capture international diversification, but you also can't be blind to the fact that the best, most innovative businesses in the world are still right here.
Yeah, that's a great point. Yeah, I don't think it has to be one or the other, right? I think sometimes you can see both US stocks do well and international stocks do well at the same time. In fact, if you look at the year-to-date number, international stocks are outperforming US stocks, but over the last quarter, they're basically both up 10%, right? You saw that in the chart that you showed for the quarter-to-date numbers in your presentation, Adam. So I don't think it has to be one or the other. It can be and as well.
Yep.
All right. So moving along, we'll stay on, we'll kind of begin to transition over to maybe just the general stock market. And I think this question here is a good segue for that, because I'm not sure exactly what, this could be a question that's asking about the outlook for the economy or the outlook for the stock market. I think we can go ahead and just answer both parts of this. So the question is, what is your outlook for quarters 3 and 4? Lowell, do you have any thoughts on that?
Yeah, this one's really easy. The market will move either up or down. And
Breaking news.
yeah, it's there's nobody that knows. I think the economics will be the driver. There's a lot that, the kind of the positive that we have right now is there's a lot of worry kind of baked in regarding potential tariff, impacts, or probably that more than anything else. And so anything that becomes good news because it's less bad news, actually is probably going to have a positive market response. So, and so I would say that if we get some surprisingly negative tariff related, especially kind of event that occurs, then we should expect a pullback in the market. Anything other than that should be kind of based on how the economy performs. And the big kind of worry right now is the tariff effect on inflation, and there's kind of a mixed from an economic point of view, the tariff impact itself, as long as it doesn't start to snowball after that, is not really considered by many economists to be that worrying. So a kind of an isolated one-time shock tariff inflation event, I think the market would take that in stride too. And it would be the snowballing effect that can occur with inflation that would be, probably the most likely scenario of significant setback. But it'll be some event. If you get a big market move one way or the other, it's probably going to be some event that we can't anticipate today that is the driver of that. It's a lot easier to ask this question, what's going to happen over the next 3 to 4 years instead of, the next couple of quarters, because the market, over those time frames is very reliable in terms of moving higher.
Yeah, it's an interesting point that you make there. I think a lot of people, have been concerned about tariffs and maybe are still focused on tariffs, but I think it's been really interesting that the stock market seems to have moved off that story as something that impacts the share price, right? Like we're back to, these tariff letters going out that in some cases are even bigger than what was announced on Liberation Day. The stock market's not even reacting to it, right? So I think that there's, as far as tariffs go, like it's sort of like an issue that shocked the market in April. It's had plenty of time to digest it, and the market's got a pretty good feeling and grasp around what's going to happen. I know some people were worried about the negative GDP print in Q1. Obviously the technical definition of a recession is 2 negative quarters in a row, but it looks like Q2 is going to be pretty strong. Over 2% in terms of the expectation for that. So we're not really seeing a huge negative impact from the economy. I think, if there's one word that's really described the economy over the last, I don't know, 15 years or so, it's been resilient, right? Like it was resilient through COVID. It was resilient through the inflation scare of 2022, and it's been resilient so far in the face of these tariffs. And, to me, like until proven otherwise, I'm probably not going to bet against the U.S. economy.
Yeah, it's the crisis du jour. I mean, remember coming like 2011, 2012, it was, how long was it double dip recession? Like it was a double dip recession conversation until the market had recovered and started to blow past where it was before '08.
Yeah, absolutely. That said, we are getting, questions as tariffs. So tariffs was another theme that I saw. So I'm going to highlight, this question here. And it kind of plays like the devil's advocate on what we were just talking about, right? Where the tariff issue is kind of being, just brushed aside by the market. So, how do we play the tariff issue if Trump doesn't cave, right? So I guess the assumption here is that tariffs are implemented at kind of like the higher rates than what the market is expecting. It's kind of a tough question to answer, Lowell. I've been giving you a lot of tough questions. I can give you this one, or if Adam, if you have any thoughts, feel free to chime in.
I can touch on it, and then maybe we can let Adam, back clean up on it. And I shared this previously. Trump has got a worldview related to trade that is very similar to my first boss here at the company's, what his view was of all of this as well. So I'm pretty intimately familiar with the way the thinking goes behind this. I guess I don't really totally agree with, with that thinking. I think that let's just say that we have when this is all said and done, some permanent significant tariff levels. The main effect of that is going to be that we're going to have a whack to worldwide GDP, because we're saying, everybody that's got the tariff on one side, they're going to have to put their own tariffs up as well. So a more tariffed trade environment is going to lessen economic growth, and it's going to have that effect everywhere. So I think, from as stock market investors, what drives stock market growth is economic growth, right? That's the underlying driver of it. So this is not great from us. But I'm not sure that, like, in terms of like trying to pick winners and losers, especially given the amount of uncertainty of what this is going to look like, is viable. It certainly doesn't fit into our investment process. So, Adam?
Well, I think, Andy, when we did the Liberation Day webinar back in April, you shared the chart showing like previous points of negotiation and contention with Trump and like how things played out from start to finish. And on the trade side, 2018 was the most recent point of comparison. And I think in general, the theme has been to drum up, kind of a crisis situation and then fix it and then move on, and kind of clean up your own mess and move forward with, maybe some wins sprinkled in there, however you want to define those. So to go, I guess if you're going to make a decision around like, is the tariff issue just going to resolve itself like it has, or is it going to turn into a full-blown trade war, which would be really bad for the global economy? You have to bet, you kind of have to weigh the probabilities and choose to bet for and against either one of those. But I think the reason why the market is, kind of not reacting to this anymore is because there's a general consensus that this is all just gamemanship and we're going to move on from it. And it's, we all know that the implications if it doesn't get settled out. So you kind of have to sit on this. If you really feel like he's not going to cave, then you have to sit into some like really crazy conservative posture and sit there and watch the market blow through you if the status quo happens, right? I mean,
that's probably a bigger risk. Yeah, that's probably a bigger risk for sure. And the other thing is, like, I'll go back to my point that I made earlier about diversification. When all this tariff news came out, it was international stocks that were holding up way better than in the U.S. Like the U.S. stock market in early April was really one of the worst performing stock markets in the entire world, and other stock markets like France and Germany that were doing really well. Like even China was like doing far better than the U.S. And like these are some of the countries that are being targeted by the tariff policy. So I just think that diversification and having the right asset mix also helps if you're concerned about tariffs taking down U.S. stock prices to an extent.
Yeah, a few people referenced, the taco trade, like the
Oh, hold
international
on.
they got the taco trade right through the whole thing, right? Like the international markets, like hardly they called taco before we did.
So let me ask a question here for Lowell. This is a test to see how online you are. Do you know what taco means?
Busted.
Yeah. It's an acronym that was popular on social media that was Trump always chickens out in reference to tariffs. We actually had a question about this. Are you taco trading? And I think the short answer is no, we're not really making trading decisions based on tariffs. Like we're going to stay the course with our with all of our strategies, kind of no matter what the thing is that's driving the market. But yeah, I did want to see if I could get you, and it looks like I was able to on that one.
Yeah, if my grandchildren are not prominently involved in with whatever the social media is, then I'm just not interested. Sorry.
Yeah, I'll leave this here. Like my serious take on this is like any sort of like social media trend. It could be taco now. It was like the meme stock mania. Back kind of in the COVID era. I think it's best to leave that online stuff online and focus on the fundamentals when it comes to investment strategy. So while sometimes these things can be entertaining to watch and follow, probably shouldn't be making investment decisions based on what the chit chat is on social media. I think we answered
Andy,
this question.
there was a second part to that question that related to the bond market.
And I'll get there. We've actually got a lot of questions about the bond market, so I'll get there. I just want to do one last question because we had this question. Last chance to give any of our 2 cents on the whole tariff topic. But best guess on the effect of current tariff strategy on portfolios. Any answers?
Current tariff strategy, like as is, none. Right? I mean, that's where we're at. We went back to focusing on earnings.
Yeah, year-to-date returns are kind of speaking loudly in terms of what the effect is. Like the effect as it trickles through the economics, of the economy, then that's what the effect is. So it might lessen. Like let's just again go back and assume something closer to the worst case, that we wind up with a significantly higher tariff environment when this is all said and done. That will adversely, affect economic growth, and therefore that's going to adversely affect the stock market. But what we're talking about is not like a cratering of the stock market. It's just the market's got less room to rise. And then, the other part of this is all of these policies, may not survive the next term, right? All of this can get undone in a few years. And so that's part of the problem with this from a policy standpoint. If you're France or you're Germany or you're some other your Apple that's trying to be bullied into, bringing, production, onshoring their production. You know, if this is all going to go away in a few years, or potentially this is all going to go away in the future, then it's not really going to have particular lasting effects. It's just like a flash in the pan thing that the markets have to deal with currently.
Yep, agreed. Just it seems like something that the market's moved on for now. Certainly, it could come back. You never know as a storyline, but it seems to have at least simmered for now. All right. So, Lowell, you wanted to answer that bond question, the second half of that question that we saw earlier. So let's get to that now. So this is a question that, can we cover the last 6 months in the bond market? What's gone down over the last 6 months, and then any thoughts on future directions? I'll just give my 2 cents here real quick before, Lowell, it sounded like you had an answer as well. But really, I think the last 6 months in bonds have actually been pretty good. So the flip side of the volatility from 2022 is that yields are higher. And so now we're beginning to cash in on that. So I think we saw on the 1 year time frame, Adam, on the chart that you showed, like bonds in the US did something like 6%. And some of that reflects interest rates falling a bit, which is a bullish thing for bonds because there's the inverse relationship between interest rates and fixed income. So bonds have, they've done their job, and I think they did their job in finally being a diversifier during the whole tariff madness. I think we had a couple instances where, like, 2020 bonds sold off a bit at the same time as equities did, at least in the initial panic of that event. 2022 certainly was a bear market for both bonds and equities, and this was the first time we've seen bonds kind of pull their weight, so to speak, and do what they're supposed to do in a little while when in the face of some market volatility. So I think bonds have actually done their job, done a good job even. So with that, Lowell, did you have any other talking points on fixed income?
So I think Adam's probably going to have more interesting things to say, but to me, rates are in a pretty normal zone right now. We've gone through periods where rates were way, on a historic basis, way too low, and they were really problematic from a portfolio management standpoint, because you wanted to have the access to them as like a stabilizer in the portfolio, but it's hard to do that when the returns are close to zero. So now that we've got more normal returns, it can play a healthy, normal part in a diversified portfolio. What will drive future bond prices is what typically does: inflation. So if we lose control of inflation, then we can expect bad things for bonds. And if we maintain control, then I think bonds are probably about where they should be. Adam?
Yeah, in the bond market, it's very hard to talk generally about the bond market because it's significantly larger in size than the stock market. In terms of number of issuers, the maturities, the yield. I mean, like, the bond market as a whole is significant in its size. And so talking generally about it's difficult, but a few things are really important, to note. Right now, you're starting out, even with government debt, with a real return just through yield on your bonds, right? Inflation now, as we've seen, creeping well below 3%. You're earning 4+% across the maturity spectrum on a lot of bonds. Government bonds, fully backed and guaranteed. So that's finally, after many, many years, an attractive place to be on a forward-looking basis. Also, the spread. So what's really important to look at is you've got U.S. government bonds, which are considered the safest debt instrument in the world, and then you've got other foreign bonds and corporate bonds, issued by companies, that they choose to borrow instead of use equity financing. The difference in yields you're receiving between those different categories is really important from a risk management standpoint. Right now there's very little yield difference between a U.S. government bond and a corporate bond here domestically. So you're not really being paid for taking risk. So our stance today is in the context of a portfolio. We tend to lean in our average, diversified model that replicates the classic 60-40 retirement portfolio. We're a little heavier on the equities side of things, but on the fixed income side, we're actually a little more conservative. So we feel like you're really comfortable sitting in that, between 2 to 3 year government, bond pocket, collecting your yield, getting your volatility buffer, and then letting the equities do their thing. It's uh, certainly much different there than trying to buy a 20-year corporate or government bond today.
Yeah, I mean, some of those long-term bonds are, I mean, behaving like, 2008 era, stock prices in terms of how much they went down during 2022, and it's just so hard for those to come back. So yeah, totally agree. I think that the posture of being, relatively short to intermediate term with fixed income, not taking on too much risks there, that's what you want to be doing. Lowell, you're getting some love, I'll say, from our webinar attendees here. They're saying good for you for not really being on social media for this stuff. And yeah, you're not knowing some of these social media trends is probably good for your health, right? I think social media maybe is one of those things that's best consumed in moderate quantities, if at all. So we're going to keep moving then. There are a few more questions that we have, and we're going a bit long here, but I just want to make sure that we can get to everyone's question. So if you're hanging with us, really appreciate that. But we had a few questions come through about the one big beautiful tax bill. So Adam, this will be your chance to shine. Let's start here. What does the no tax on Social Security mean to someone who is 78 years old, or let's just generalize this to receiving Social Security?
Well, I think the first thing is that there's not a no tax on Social Security provision here. I know that was one of the big campaign talking points. They were having issues getting that pushed through, and they essentially changed the no tax on Social Security provision to this additional deduction for seniors. So for tax filers 65 and older who have income below 150,000 if they file joint, or 75 if they're single, you get an additional $6,000 per 65 plus tax filer on your return for the next few years. This is good through 2028. So it's a short-term write-off. And effectively, what it does to your tax return will depend on a number of things, right? Because ultimately what's happening is the standard deduction plus this is turning into something really significant. So a married couple, both 65 and older, the standard deduction this year is almost $35,000. You layer on an additional 12,000 on top of that with the 6,000 apiece senior deduction. Now what it means for you is you've effectively significantly reduced your income. So you're either A, gonna just pay less in tax if you fall with the below those income phase outs. B, it might open up room for you to consider certain tax strategies that might not have made sense before, depending on your age, right? If you're not taking RMDs, you might have more room to do things like Roth conversions. You might think differently about where you're pulling your retirement paycheck from, depending on what tax bracket you're in. So essentially what it does at the end of the day is you combine that with whatever you itemize or take on the standard deduction, and you've got a nice bigger chunk to offset whatever income you report. So I did get a question via email a while back about what does this mean for my for IRMA for my Medicare premiums. So I think it might make sense to throw that into here. This effectively acts as a below the line deduction. The IRMA calculation is based on a modified adjusted gross income calculation that's before any below the line deductions are applied to it. So this senior deduction won't impact IRMA or your Medicare premiums, but it will open up some other planning opportunities.
Yeah, that's an interesting nuance for sure there. The other question we got on this, Adam, was about charitable contributions. So I'm interpreting this question as being for those of us who do charitable contributions, but we don't itemize. So we're taking the standard deduction. My understanding in the new tax bill now, you can take some charitable contributions up to a certain limit. Is that right?
Starting next year. So the charitable changes kick in 2026. So if you don't itemize, you file single, you can write off $1,000 worth of charitable gifts against your income. If you file joint, you can write off 2,000 of your income as charitable gifts. So it was $300 and $600 during COVID. They've simply brought that back and raised it. And again, it's permanent. So yeah, you don't itemize. Actually, if you itemize, the impact of this bill is negative if you itemize and make charitable gifts because you've got that new 0.5% floor. But if you take the standard deduction, and I think that's kind of like if you bunch all this up together, think of it as a 65 and older taxpayer, you've got, a significant standard deduction plus this new senior deduction plus this potential ability to write off smaller contributions up to a couple $1,000s. You could start to add that up and see something meaningful on your tax return, but that's the mechanics of it. But again, this starts next year.
Okay, great. Appreciate that answer. And again, I'll plug this one more time. But Adam did a solo podcast episode on that. Again, long story short, is the name of the podcast. It's a weekly podcast that we're putting out. And so there's a whole episode dedicated to just this topic. And we also have a blog post on our website at berniewealth.com, that will get you read up on all the relevant things that are likely to have, some impact on you. So we've got just a handful of questions left. And so we'll try to get to these real quick. And we've got a couple different themes here. So let me start with the private theme. So, this question's about Jamie Dimon saying that private credit has gotten really dangerous, but then they decided to get into it at the tune of $50 billion and requesting comment there. The other question was about how do we tap into private markets now that the number of publicly held stocks keeps declining. So two topics here, private credit and private equity. We do utilize private credit in our asset allocation models. We are looking to see if we can find access to a private equity fund that might be interesting and accessible for our clients. So Lowell, I know this is something that you're pretty passionate about. So your take on both private credit and private equity.
Yeah, so on the private equity side, and this kind of relates to the shrinking number of stocks, there's a lot of companies that are no longer going public early in their existence. The norm 10, 20 years ago was to get some venture capital to kind of get started, and then you became a public company relatively early if you were a successful company. There's so much capital now invested in these private markets that they don't need to do that. So they can, somebody that is a private owner of a company that's doing well, they can hold it. And sometimes when they do become public, they're massive companies that get launched as a new public company. So getting access to the good stuff is what I'll describe. That's the problem, with these markets is kind of the rut, because there's a lot, and this is like the first question regarding, the private credit markets kind of getting extended. There's a lot of money chasing, those opportunities. And as soon as you get like that supply demand imbalance, you start to wind up with, companies being sort of forced with some of their investments, and they're not able to be as selective as maybe they once could. So it's a place where there will be a lot of disappointed investors. It's kind of the norm of the privates is you end up getting disappointing returns with really high fees. Like if you were just to summarize over the last 10, 20 years, the experience of most investors in privates, that would be the conclusion. Having said that, though, there is good stuff out there. It's just hard. You have to be very selective. We spend a lot of energy with our diligence of these markets, and so there is a good way to do this. It's just a hard way to do it successfully. We've had a lot of success with our experience with the privates, and we're going to continue to invest significantly in this area because it is it's a great diversifying asset if you can get something that doesn't have the disappointing returns with really high fees.
Yeah, Appreciate that answer. Adam, any thoughts on private credit and maybe Jamie Dimon's about face on it?
Yeah, I don't know what it is in terms of timing, because I literally just read that article this morning that talks specifically about Jamie Dimon and what they've been doing at JP Morgan with private credit. Jamie Dimon is a really good banker, and he's paid to be a world-class risk manager. He's paid to be afraid. So when he makes comments like this of like, hey, I'm really worried about this or really worried about that, like in 2022, he said a hurricane's coming. Um, he's paid to be paranoid. He's got no upshot in being aggressive or a gunslinger. So that's not surprising. And a kind of the tenor of that was like one of the big blunders of JP Morgan, of Diamond specifically, was that they didn't aggressively enter into the private credit space as it was blowing up. And they're now starting to venture into it. Um, I agree with the Lowell. There's a lot of garbage in that space. You have to be really careful. With assets come new investments and new groups of people trying to, collect fees, which is why we spend a lot of time looking at these specific vehicles. But uh, related to uh, the big banks specifically, the genesis of private credit getting as popular as it is, because we wouldn't have been talking about this 15 years ago. It's after the financial crisis, a lot of the regulations that were rolled out really handicapped banks in terms of their ability to make loans to mid-level companies, mid-market companies that were still really financially in strong positions, but private lenders were able to make way more favorable terms. They were able to get better covenants for themselves. And so it's kind of like this win-win scenario that unfolded and the big banks couldn't take advantage of. So there's a legitimate case that both the company and the investor really went out in these scenarios. And now it's just a matter of the volume game. But JP Morgan and other big banks are now throwing themselves in the ring. I think they have to be nervous by nature. You want to see a big bank act nervous, but they certainly see the opportunity, or they wouldn't be getting into it now themselves.
Yeah, that's great. I know private credit's a big part of what we do with our asset allocation models as well. So they've proven to be diversifying, especially in a year like 2022. So just it seems like a good asset class to allocate to, despite some of the headlines that you might see. There's one question about a specific stock that I'll address here, and then we'll close it on the theme of AI. So plans for CNC. So this is a healthcare stock called Centene. So the question is, what happened, and what are we going to do with the stock? So some clients, not all clients, but some clients certainly did own this position as it rated as viable in our stock selection model. What happened is the company withdrew guidance during their last earnings report, which is never a good thing for the stock market. And they withdrew guidance partly because of concerns about Medicaid cuts, but also partly they horribly underestimated costs as well. And so those two things combined caused them to withdraw guidance, and the market certainly fears what that means once they do propose guidance again at some point in the future. So what happens when we see a stock like this, where that has this precipitous drop over a very short time frame, is we typically don't want to overreact, because we don't want to get caught into some of the negativity around it. And what you often see is there'll be a big drop. That's an overreaction, and then it kind of settles into a lower but not quite as bad equilibrium from there. I think in Centene's case, we're continuing to see weakness. So my guess is this is something that we'll be looking to move on from sooner than later. But that's just sort of what happened and what to expect. And I'll generalize that, to any stock that has, weak performance over the last 6 months, or especially if it has a huge drop off in the last month, we'll typically look to get out of positions like that and just move on to other opportunities. And so on the AI front, we had 2 questions. One, I've heard Vanguard and other big firms are using AI to enhance performance. How are you using AI in our portfolios? And the other question was, how are you adjusting the portfolio to accommodate the likely market disruptions we can expect from AI? So I think it's market disruptions from AI and our use of AI are really the 2 questions here. Let's start with possible market disruptions from AI. This has been a really interesting theme to watch because coming into 2025, it seemed like the AI trades were just gonna, eat the entire market. And, Nvidia and Meta and even smaller firms that were investing heavily in the chips that make up AI computing power or just AI itself, like any stock that had AI in the name was doing extraordinarily well. Then we got the DeepSeek news in February, and you saw the whole AI trade just turn on a dime. And now all of a sudden, people were concerned about valuations and investor sentiment was souring. The word bubble got thrown around quite a bit with AI stocks in particular, and that really, the tariff news in early April certainly didn't help either. And so we saw the whole AI trade kind of turn around and do relatively poorly for a period of a few months. The AI trade is back again. So if you look at the S&P, 1500 for the total market, or even outside of the 1500, so smaller firms and ADRs, stocks associated with, AI have been doing well again. So this is certainly something that we're watching closely, and it does impact investment decisions to an extent. I would say that the good news here is like almost everyone, if you're investing in virtually any investment fund or investment strategy, you have exposure to AI, right? All the big firms are doing it: Google, Meta, Nvidia, right? These are going to be the biggest holdings in a lot of our portfolios and a lot of other investment strategies. So you're getting that AI exposure already, and that's sort of you can see that, I think, to some extent with our size and style, specifically our style posturing, where we're leaning heavily into large growth so that we have access to those large AI players, where maybe we're not doing that so much amongst small and mid caps. So that's kind of like my answer as far as AI goes in the investment portfolio. Lowell, do you have anything to add there?
Yeah, so this is the latest disruptive technology. It's a normal economic event to have something new and impactful occur that basically everybody has to respond to. This is going to have really profound negative consequences for all the firms that are not adopters, of this. Like basically, you got to get on board or you're going to die. Pretty much any business anywhere of any size. Our business, any business is going to have to adapt to this new, very powerful technological advancement. But at the end of the day, this is whenever these things occur, there is an enormous productivity boost that occurs also with disruptive technologies. And so we're going to get, on an overall basis, a big tailwind that, as this ripples through the economy and starts to affect, productivity at a per worker level. But there's going to be lots of disruption in the short term. So this is going to be tough for certain individuals that find themselves unable to do their jobs because one person with an AI can do the job of maybe 10 previously. But on an overall basis, this is going to be very beneficial for investors, and really just economically for the world.
For sure. And this question about like use of AI, and so the trend, because we've been watching AI trends very closely in relation to the asset management business, in relation to the financial advice business. And what I can tell you is like a lot of firms, probably not most, but a lot of firms are using AI tools internally to help with efficiency. Things like being able to interpret a 900-page tax bill quickly and efficiently. That's a great use case for AI. And there's all these tools now for really any industry where there's people who are building on AI models and delivering solutions to specific firms. What we haven't seen a whole lot of is firms using AI to help with their investment process. I think there's just a lot of hesitancy to do that. What I would say is this is something that we've actually been doing kind of before it was cool to do it, right? We're kind of like AI hipsters in a way. In the way that we've been implementing AI in our investment portfolios is we've talked about this a few times on these webinars, but there's a signal that we use in conjunction with our main stock selection model that doesn't know anything about the valuations or the growth or the profitability of a company. All it's doing is scraping the web to figure out, the digital footprint of a company and all its brands to try to guess like is that company about to surprise when they report on revenue during their next earnings report, right? That's the whole deal. And that signal, to be able to find, all this unstructured data and find signal in the noise, it's been using advanced statistical techniques, including AI, for quite some time. So we actually have been using a signal that leverages AI to help us predict the stocks or find the stocks that are predicted to have a positive surprise on earnings day, and then get into those stocks before they report, right? So that's kind of how we've been using it for a while. It'll be interesting to see that trend, to see if there, are firms that are going to increasingly adopt AI for their actual investment strategies. That's actually a bit of a harder problem than you'd think. So it'll be really interesting to see, trends there. One final question we got right before the buzzer was this question on crypto. So it's true, we have not discussed crypto a ton on these webinars. Sometimes it comes up in the Q&A section at the end, and it's certainly the case that your ability to invest in crypto is easier now than it's ever been before with the Bitcoin ETFs. Now there's things like Solana ETFs, and my guess is soon you'll have virtually any coin in an ETF wrapper. This current SEC is much more amenable to having these crypto funds out there. So our attitudes about crypto and in the future, it's kind of my personal take is that crypto is an interesting space. It's certainly speculative. You can expect there to be really big, wins, and also really big downturns as well. So it's just going to be the riskiest asset class that you can have. It's sort of like stocks on steroids. So if you have the stomach for it, perhaps you can safely now, without fear of your crypto being stolen, invest in it. It's not something that we're recommending in client allocations at this time, however. Lowell, Adam, do you have anything else to add there?
Yeah, I mean, it's in the headlines, obviously, and there's usually a real strong correlation of it being in the headlines and its price going up. So this is, certainly something people are paying attention to. The hat that we wear as advisors is we have to, anything we invest our clients in, we have to be able to point to that investment and give a really strong case of why we're doing it. And a lot of the times that's backed by fundamental research. What's the intrinsic value of the investment? What is it that we can put our hands on and say that this is something that warrants a place in an asset allocation? Crypto and blockchain, it's an interesting case because I don't think anyone's really arguing its place in the world. Its growing market capitalization only supports it. But as advisors, in the context of an investment portfolio, right now with Bitcoin specifically being the leader of the pack, it's hard for us to connect that to a specific asset allocation when we've got other assets available with more transparency, more history, greater ability to value that we can say can help our clients get from point A to point B. So for clients that are excited, and kind of to your point, Andy, we have people that are excited about crypto. They've got a higher risk appetite. We can help kind of coach them through pros and cons and what that looks like, but that ultimately becomes a client decision.
Yeah, and
Sure.
I agree with that assessment. It's from our vantage point, without being able to come up with something that is a fundamental basis for value, it's very hard for us to make that recommendation. It's a very volatile asset. I think that it suggested it's a tradable asset. Like if I were going to involve myself in crypto, and I don't, but if I were, I would look to be, just in and out of it as the natural volatility of that asset class unfolds.
Yeah, it's a supply demand game. So, it's going to be inherently volatile as a result of that. And could it continue to increase at the rates we've seen? Sure, but I'd also expect it to probably have a 90% drawdown at some point in the future as well. So if you're up for that roller coaster and able to play it, it's certainly doable and easier than ever. But yeah, I think that's a case by case basis depending on the client and what they're looking for. So I wanted to thank everyone for joining us today. This was, I think, a record for longest webinar that we've done. We're clocking in here at about 90 minutes, so a nice tidy 90 minutes. But we wanted to make sure that we could answer all of your questions because there were a lot of good questions here this time, as there always are. But I just wanted to say, quickly, thank you everyone for joining us today. The replay will be available on our website soon, so if you want to send it out to anyone else in your life, please feel free to do it. But for Lowell and Adam, thanks again.